Hi, I'm Peter Rose, founder of Longwood Currency Trading. When not to use a profit target limit order to get out. I think that in a lot of the conversations I've recently been having with folks that have been emailing me, there's been a misconception about how I do my entry analysis. If I don't have 20 or 30 pips of space between where the current price is that I'm going to be taking the trade to where my profit target is, then I'm not going to get involved in the trade. So I need at least 20 pips to the profit target in order to warrant getting into the trade, because I'd like to make 10 or 12 pips on a regular basis. I can shoot for more, but that's where I'm trying to get to. In any event, when I'm talking about doing this, it seems very cut and dry. Look, I got 20 pips to the profit target, I satisfy my other entry conditions, boom, and I'm in the trade, and the price moves and it hits my profit target and I'm out. And that's not exactly the case. That's like playing a game of football. You lay out the conditions of the field so that you have these 10-yard lines, and the goal is to get 10 yards. But if you're running really fast and you don't have anybody that's close to tackling you, you run for as far as you can run. And so in getting involved in email conversations with a couple of folks, they just don't understand how you set a profit target, but then you don't respect it. Well, I respect it. I'm really glad that I got it. But I was in a trade the other day. I made I think I made $800 for the day. One trade. Took me 15 seconds to see the opening. Boom! I went in and I'm gone. However, I got out early, and I could have made probably $2,400 if I would have stayed with that and followed it. But the thing was, the conditions at that particular time brought in a corollary of my rules for trading that said, if you are experiencing these particular conditions during the price action, then you probably ought to just get as much as you can from the trade, but don't try to push it beyond the profit target. And the reason for that is your profit target is set not just as some arbitrary thing. There's a reason that you set a profit target, right? Now, I don't know what conditions it is that you would use for setting where your profit target is. I hope it's not, I'm going to get 3 to 1 on my risk to reward ratio, and so my risk is 10 pips, and so I've got a profit target of 30 pips. I mean, that's just ludicrous. That isn't even sane. So you have conditions that need to be met that say the price could run to your profit target. But again, you have to keep in mind why that thing has been defined as a profit target. More often than not, it's because there's order flow congestion at around that area. Not a point, but a zone around that area. Now, you set a profit target for 20 pips, but you could have 8 pips on either side of that, a 16 pip range where you have this order flow congestion, where you see that stops are getting hit and prices having a tough time getting through that. Well, as you are watching the price move forward, you are judging the momentum that order has, that price has, in relationship to the viscosity of the order flow that's around you. It's a classic problem in physics. It's a resistance problem. You have a block on an inclined plank, and the block has friction between it and the inclined plank. So how fast will the block go? How far will it go if you release it? It's dependent on its weight and the resistance of the plank. And in trading, it's the same thing. You have a plank, an order, that's being pushed by price action or gravity, and what's slowing that down. Order flow increasing is a good indication that you've got the momentum get going, but if that order flow starts to lessen, then the price probably won't get to that profit target. And if your order is running into a viscous environment, an environment where there are a lot of other orders that are contrary to where you're at, you're going to find the price begins to slow, that there's a resistance to that price moving into that cloud. And so rather than saying, oh, I've got this 20 pip profit target, the thing has got the initial calculation of the momentum is that blah, 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 and I'm going to let it run to the 20 pip profit target or beyond, whatever. You have to say, well, wait a minute, the conditions have changed. I'm a day trader. I'm on a 5-minute chart. Conditions can change in 10 seconds because there are times where I'll be involved in situations like that where I'll drop down onto that 5-second chart, and if I see that price changing dramatically, remember, if I'm on a 5-second chart, I've got 12 of those in a minute, and so 12 5-second bars is an eternity. And that if you're day trading and you're on that 5-second chart, that ATR might be, I don't know, a quarter of a pip or maybe a half a pip or something like that. Well, okay, so you take 10 of those and now you've got 5 pips. And that's giving you a precursor to what you're not going to see if you're out on a 5-minute chart time frame. So you can see that price beginning to degrade. So why wouldn't you get out and preserve that? I got out because I was unsure and made $800. My profit target was I think it was $950, so I was almost there, but it was time to get out. Now, the conditions after I got out didn't manifest themselves the way that I thought that they might. It's a probabilistic exercise. So what am I going to do? I'm going to beat myself up because I could have let the thing run to $2,400 profit? Or do I say, look, I made $800 on that one trade? So trading, as I've said many times, it can be rule-based, but the rules aren't static, right? If you're driving your car, the rule is drive it on the road between the white lines. That's could be viewed as a static rule, but you can kind of waver between those white lines. You see a pothole or something up ahead, or the gravel is washed into the road. You may sway out of the way of that a little bit. And in fact, if there's a huge hole and there's no oncoming traffic, you may sway really hard, even into the other lane, in order to avoid that. I had to do that the other day. I took my dog for a walk, and Sue and I took him down to one of the wooded areas with a lot of trails. It's off on a dirt road. It's a paved road, but then it turns to dirt for a while. And we're driving along, and we're watching the road real close, and I go, holy crap. Had to turn the car way over onto the other side of the road to avoid not only some really rough turbulence that I spotted up ahead, but there were some really significant potholes that could have done some damage to the car. So in trading, you wouldn't go into the other lane. You'd get out of the trade because there is no other lane. You're either in the trade or you're out of it. So I changed lanes, and that's going out of the trade. I closed the position. The fact that the road clears up after the fact, that doesn't matter. You have to be able to make those decisions appropriately if you're going to day trade. Now, a lot of people say, well, that's too much work. Well, I'm sorry. What are you going to do? Trade on the day, the daily candle? And so you set your trade at 7 o'clock in the morning based on the day before's close, and you go off for the day, and then you come back, and that candle with an ATR of 80 pips has gone 40 pips against you, and you're stopped because you listen to the stupid risk to reward ratio. You were looking for 3 times 80, 240 pip gain, and so you had a I don't know, 70 pip stop, and so you come home that night and you've been stopped and you lose 70 pips. I don't know, I'd rather come home and lose 8 or 10 pips because I was wrong. That thing could have gone 200 pips against you in the time that you're away. And you could say, well, I set the stop for 40 pips, and as the thing moves forward, I trail the stop behind me. Okay. You're abrogating your responsibility to know how to trade to an automated process to get you out. No way to determine whether that's a minor retracement and you still have plenty of momentum left in that trade to have it continue on forward. If you read the story of the rules that Richard Dennis created for his turtle traders, you'd see the concept that I deal with down on the 5 and 15-minute charts, on the weekly charts that Dennis was running his guys on. And those rules are basically the same, except if you're going to trade for weeks on end, you can't be there 24 hours a day, 5 days a week to watch those positions. So your rules have to be expandable based on the time frame that you're on. So when you're listening to what I'm sharing with you on these videos, don't get so wrapped up in the rule or the way to do the thing, because that's just a part of a rule. I'm basing my ability on my ability to trade, not my ability to create rules. Rules are a suggestion, and they are rules to keep you out of trouble. Rules are risk management on one hand, and they are also profit enhancers on the other. And you have to understand what the function of the rule is, because it can't be both. And that's why I've got 3 rules, and each one of them have corollaries to them that flip the other side. If this condition is true, and this condition is true, and this condition is true, then I'm going to do this. If condition A and before was true, and condition B, this is true, but this one becomes false, then I've got another thing to do. The more conditions that you have, the more permutations, right, that you have in the execution of that rule. And again, you don't want to have more than 2 or 3 conditions in that rule, and hopefully those conditions are sequential and chronological and not just random conditions that, if it's if it's Tuesday and the sun is out, then you do this, but if the sun is not out and it's Wednesday, then you do that. You have too many variables interchanging there on the conditions of that rule. So you have to be very careful about how you structure those rules, so that when somebody says, here's my profit target, but gee, I didn't get out, I got out here and I made 60% less because I got out here, and you can't say, well, yeah, but why bother to set a profit target? There are reasons that you set the profit targets, and there are reasons why you get out early. So you just need to be aware of that. And so when you write me for questions about that, ask a question, don't be aggressive about, well, you said this, but this is what you tell me that you did, and that's wrong. Why don't you do what you say? And I get those questions from people who don't understand how to trade. And I find that really upsetting, because you're out there risking your money without knowing how to trade based on what some fool told you about don't risk more than 1/4% of your account, follow the RSI, and forget bat patterns, and you know, here's your stop, and you respect the stop, and here's your profit target, and you shoot for the profit target, and it's not that rigid. If it was that rigid, it would be easy to construct rules to beat that situation, right? That's why a chess master can look at the board and go, it doesn't matter what you do. If you do this, I do this, I do this, I do this, you have to do that, and 6 moves and you're done. And you go, nah, I don't think so. Oh, okay. Because you want to debate that, you're done in 5. And trading is the same thing. If you have those static conditions, you could easily build rules to not get involved in the situation that's there. For example, you're running into a order flow congestion. You got a strong level, a very strong level, and you're 15 pips away from that level. What do you want to do? Go long into that? Well, I don't think so. So why bother to go long, because the so-called profit target is 8 or 10 pips into that zone, and you go, well, I'm going to go to the line. Why are you trying to fight the conditions that trump your rule? You can't. So, interesting conversations I've had. Keep them coming. We'll be happy to discuss it, and when things like this come up, you know, I'll be happy to do a video to try to help you understand that it isn't so much the rules that you need to understand, it's how to trade, and then you base your rules on what you understand the trading process is, right? Okay. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.